to our first time home buyers webinar. Thank you so much for joining us tonight. We're thrilled to have you here as we explore everything you need to know to make your home buying journey a success. First, I would like to introduce you to our real estate experts. Joining us tonight, we have Nick Hoffman, our VP of Consumer Lending. I'd also like to welcome Katie Bird, our valued and experienced real estate loan originator supervisor. All right, before we get started, let's just talk about some of the objectives tonight. This is a really high-level overview of the home buying process. As Katie and Nick can tell you, it can be some transactions are longer than others, but really we want to demystify the home buying process. There might be some terms you've never heard before, and it's really important before you jump into this process to have a good understanding of what to expect. Also, just because we care about our members and consumers, we're going to go over just some things that you can do to see if you're ready to purchase a home, some things to consider whenever shopping for a home, and then, of course, all the nitty-gritty of the transaction itself. We'll go through that with you also. So,
right, thanks,
Katie.
Lindsay.
Yeah.
So if you're on here tonight, you're probably considering making that leap into home ownership. So just some pointers that we kind of like to go over with people to help you determine if you're ready to do that. Some things that will be important if you're working with a lender are, do you have a steady job? Are you planning on staying in the area for a while? You know, if you're purchasing a home, it's a long-term investment. So kind of just thinking about, are you really thinking this is where you want to lay down your roots? Another really important thing to think about is your credit. If you go to annualcreditreport.com, you can actually pull a credit report that's going to show you pretty much what we see as the lender. So you'll be able to see what debts are reporting on there, if something has happened to show up on there with a late pay or a collection, and you know, if there's by any chance something that someone has put in your name that's showing up on your credit. So this is something we actually say it's a good idea to do anyways, but especially if you're looking to purchase a home, kind of going into that knowing that you've checked your credit and you know that everything looks good, so you don't run into any surprises on that. And then another really important thing to think about is your down payment and possible closing costs on that. You know, you don't want to use all of your assets that you have to go towards purchasing the home. So just kind of knowing what you have and kind of what you have set aside for purchasing the home to determine if you're ready to make that move. 20% is always an ideal number to work towards for a down payment, but there are a lot of programs and lenders that can do as little as 3%. So just knowing that you have some assets set aside and ready to go for that.
Katie, I'm glad you mentioned the annual credit report. This is something that we say all the time. We've hosted many webinars over the last couple of years here at campus, and that's something that always comes up. I think just as consumers, it's really important to just always have a pulse on what's being reported in on your credit report so that you don't have any surprises. But definitely before even going through this process, you don't want to get it started because I believe it can take some time to get things off of your credit if you dispute them. Is that right?
Yeah, absolutely. So if you have something on your credit that you do want to dispute, a lot of times it can take 30, sometimes 60 days for that to actually report and fall off of your credit if you have to go through the dispute process and then it has to be reported back to the credit bureau that it is incorrect. So we would just hate for you to get to the point of you're ready to make an offer on a home and there's something on your credit that you weren't aware of. So it's definitely something to keep an eye on.
So everyone should just check their credit
Yes.
tonight. Yeah,
yeah,
just do it.
All right. So I guess if you made it through step one and you've checked your credit and you've decided that you're ready to purchase, usually the first step really is, trying to figure out how much home can you afford. Some people, kind of have that number in mind that, I wouldn't want my house payment to exceed X amount. But knowing if that fits into what a lender would approve you for. So really, if you're going to be getting a mortgage, a lender is going to look at a couple ratios. The first one being your housing, or what's called the front end ratio. As a rule of thumb from a lender, we really like to see 28% or less of your gross monthly income is what your house payment would be. So there are instances where sometimes it's above that, but anything over 28%, and most lenders start to get a little worried that just too much of your monthly income is going to go towards just a house payment. Um, and then also the debt to income ratio, or your overall debt to income ratio, is kind of the second ratio that they're going to look at. Um, that one obviously can be a little bit higher, more in the 40 to 45% range. And calculating that, Lindsay just put up on the screen, there's a calculator on NerdWallet that's really easy to work with to calculate your overall debt to income ratio. So if you've kind of figured out what what you'd want that mortgage payment to be, you can plug it in. And then going into your debt ratio is any borrowed money. So a car loan, a minimum payment on a student loan, credit card if you carry a balance each month, anything else like that. It doesn't take into account, insurance or cell phone or anything like that. It's really just debt payments. But on this calculator, you can kind of enter that information. You can put your gross monthly income there on that sliding scale, and then you can calculate, and it will kind of spit out, what that debt to income ratio is. And so obviously you can kind of play with that mortgage payment number too, and kind of find out where that ideal, 40 or less percent debt to income ratio is for you.
Or if you're considering doing this down the road, maybe you can use this and see, okay, well, if I pay off this loan, how is that going to affect my debt to income? It can really help you plan. That's what I like about that.
Yeah, absolutely. And then when you're figuring out, the monthly payment, if kind of how much you can afford and like I said, some people kind of have an ideal monthly payment they want it to be. We have a calculator on our website there that you can kind of put in the mortgage amount, the term. We have interest rates quoted on the website too, so you can kind of use that as a guide on the interest rate. And you can kind of play with that mortgage amount, and then you can see there at the top of the screen where it kind of spits out what that monthly payment is going to be. So you can kind of see what, what the difference of a 30-year to a 15-year to a 20-year term would do to the payment. You can see what going from 200,000 to 250,000 does. You can just kind of play with it. And then, there's a couple spots there for the annual property taxes and homeowners insurance, because those two things are items that we really encourage people to count toward as their monthly payment. Even if you may not pay it, some people pay it with their mortgage payment, some people don't, but either way, it's an expense related to that house that you need to budget for. So if you started looking, most of the websites out there have a tool where you can see what the property taxes were last year on the home. And then the homeowner's insurance is kind of something that you can kind of estimate. But these are all good tools for those that kind of like to work ahead and try and plan on their own. The other thing we say is all of this information is really something that a mortgage professional can go over with you too, especially if you're a first-time home buyer or new to this. Sometimes just having that conversation or sit down with a mortgage originator, they can kind of go over these numbers for you too.
So Nick kind of just went over some of the numbers that you can work with at home, kind of just playing with your income and your debts like Lindsay mentioned. But once you've done that, or even if you haven't done that, kind of the next step would be to meet with a lender and work on getting pre-approved. So the pre-approval process is truly a process where you're going to complete a mortgage application, your credit's going to be pulled, and you're going to walk away from that knowing what amount you can borrow based on your income ratios that Nick just went over, and kind of what the interest rate is looking like at the time. We can tell you estimated closing costs, what your estimated payment will look like, and kind of just go over all of that. Another thing that can be done if you're not quite ready to get pre-approved, but you're also not really wanting to do those numbers by yourself, is reach out to us. We can go over those numbers with you, like Nick said. We can run the figures, just kind of figure out what your income is, kind of just go over those and tell you this is probably a good range for a payment, which is going to be kind of this range for a sales price on the home. So just to kind of give you an idea so you can start that process of kind of just searching and seeing if it's going to fit what you're looking for. Campus does not charge any fees to do a pre-approval, to go over those numbers with you, either of those options, and there's no application fees or anything like that. And really, credit unions as a whole are great to work with. Campus, you're going to save money on your closing costs if you work with a credit union. There's some costs that credit unions don't have to charge, such as the intangible taxes. So that's where it's going to save you on those things. We have very competitive rates. And you're really not just a number to us. Everything's done local with Campus. So you're going to have an originator that you work with. When you get to your processor, the closing, all of those people are local, and you can call them up and speak with them. You're not having to worry about what time zone they're in, or getting bounced around from location to location. It's all local, and we're all here to really help you as a member, and you're not just a number to us.
That's the best part, like really knowing who you're working with. And I know, Katie, that's something you really enjoy about your job too, is just working closely with members and getting to know them as people too. So it goes both ways.
Yeah, I was going to say that's definitely a perk for us too. At the end of the process, we know a lot about our members, and we've helped you with a big purchase in your life. So it to us, it's very rewarding on our side as well to do that.
Yeah, for sure.
All right, so if you've gone through those steps and you've gotten your pre-approval, and you're kind of ready to really start looking, we always say it's a great idea to sometimes just get out the old pen and paper and really make a couple columns of needs and wants, and really sometimes defining what is a need versus a want in a home. If you have children, or you're planning to have children, or maybe expecting a new child, there may be a certain need of bedrooms that you have. And so, that would be a need. You may want a pool in the backyard, or you may want granite countertops, but it's not necessarily a need that would change the home. Same thing with animals. If you're a dog person, you have a dog, you may need a certain size backyard. And so again, you can instantly rule out some neighborhoods and some homes that just don't have a backyard large enough. So really, before you even start shopping, trying to put those down on paper, or figuring out what is a need, what is a want, and then that way, when you go to look, you can at least look at homes that meet all of your needs, and check those, and make sure you're checking off your needs, and then trying to check off as many wants as you can when you're looking for a home.
Yeah, I think, depending on the market, how much inventory is really out there, you might find that some of your needs are actually wants when you're really looking, like supply and demand, but yeah, the deal breakers are really, really, really important for sure. Don't compromise on those.
Yeah, absolutely.
Yeah, so once you've kind of taken the time and made that list, like Lindsay just said, you don't want to compromise on your deal breakers. So when you start shopping for a home, when you know what items are true needs and they're deal breakers for you, make sure that you don't compromise on those. But also keep in mind that there's some things like those wants that we talked about. If you're looking at a home, we always say don't prejudge them when you're looking at them, let's say online. If you're looking at a home and the paint color isn't really what you want it to be, that's more of something that you can fix, rather than if you need 4 bedrooms and you're looking at one that only has 3. So we always kind of recommend don't prejudge those homes when you're looking at them. Zillow, Realtor.com, those are both going to be great sites that you can go to, and they have filters that you can use, so you can put your needs in there. If you need the 4 bedrooms, you can have that in there, so it's only going to filter and show you those homes. But then once you see those, really consider all of them that meet those needs for you and fit in your range of the price that you're looking at, and those types of things. because again, when you get to the home, sometimes what you see online is not, it's not everything that's there. So we recommend going and giving them a chance. Um, and then when you do go look at the home, another big point that we like to point out is showing proper etiquette when you go to the home. So there are going to be times that you're viewing a home that's a brand new home, never been lived in. So you have a little more leeway to, look in the drawers, open the cabinets, look through the closets. When you're going into someone's home when they're still living there, you probably don't want to, go through their closet or open up their drawers and see what they have in their junk drawers in the kitchen. You really want to remember that you're kind of a guest in their home at that point because it is still their home that they're living in.
It's funny you mentioned that too, because we'll also um, when we're talking about fraud and things like that, we'll tell people who are selling their homes, like, don't leave those things behind, especially if you're selling your home, but that's on another topic. Definitely having that proper etiquette, and you never know who's watching, really.
Yes,
Yeah.
for sure. So also when you're shopping for the home, here on the screen, you can see kind of some other things that we consider important considerations. Some of those are going to be things like the age of the home. So if you're looking at a home that is 15 years old, you can usually see the age of the home on Zillow or Realtor.com. It can show you that information. If you're looking at a home that's 15, 17 years old, it's likely going to need a new roof soon if it doesn't already have one. So there's some items, the appliances, those types of things dependent on the age of the home that you may run into that, okay, if I purchase this in the next couple of years, I'm probably going to have a pretty large expense here for that. So that's always one that I find really important to talk about. And then the homeowners association is another one that, I like to mention because you want to read those bylaws and see what is in there, because you just never know. You may think you're purchasing this home. Once you become a homeowner, it's your home. You do what you want to do, but that's not always the case. If there's an HOA in place, they may limit, if you can have your boat in your driveway that you may own, or what color your home is. So just taking the time to read those before you get to the point of making the offer on the home can be really important to make sure that you're not going to obligate yourself to a home that you don't feel like is your own once you get there.
On the last slide, there was a picture of a yellow home and a shopping basket, and I had to think of that. Like, if your dream was to have a yellow home and you buy it, and the homeowners association says no, your house cannot be yellow, just don't say we didn't warn you.
Yeah.
That's important.
Yeah, it can happen. I mean, we see that happen. So
Yeah.
So once you've kind of, gotten pre-approved, you've gone through, looked at homes, toured them, you finally found one that you are ready to make an offer on. There's a number of things to consider, but the first is kind of understanding what market you're in. There's usually two types of markets. They call a buyer's market or a seller's market. A buyer's market is really where there's a lot of houses on the market and not as many people buying. So homes tend to sit on the market a little bit longer. You may be able to find, 8, 10, 12 homes that fit your needs, and tour a number of homes and take time deciding, and then usually can even try and negotiate on the price and maybe some other things for it. Then there's also a seller's market, though, where sometimes there's less houses out there than there are people wanting to buy. In these times, a lot of times you may be lucky to find one or two homes that really fit all your needs. And once you do, you have to understand that there may be other buyers out there that it fits their needs too. Homes tend to not sit on the market for very long in a seller's market. So if you find one and it checks all the boxes, you have to understand that sometimes you have to come in with a really good offer, and you may not be able to negotiate the price down. You may not be able to have as many contingencies and that sort of thing. So understanding the market you're in definitely helps when you go to make an offer to start with.
Yeah, we recently saw quite the seller's market, and it was it was hard. I know we had members who were pre-approved, and it's hard to shop in a seller's market because you're competing with so many other buyers, and it's hard not to fall in love with a home and then just say, okay, this is my home. So prepare your emotions for this process too,
Yeah,
because
it's
it
not,
can
in a
be
seller's market, it's a
emotional.
good point. In a seller's market, sometimes you may make an offer on 3, 4, 5 different houses before
Yeah.
you actually get under contract. Because again, in a big time seller's market, your offer may be one of 3, 4, 5 offers that they're getting. So yeah, it can definitely be more difficult in a seller's market. And yeah, like I said, the market also shifts. We've seen a seller's market for a while, and we've started to actually see a little bit more of a shift here recently, where homes are starting to sit a little bit longer and not move as fast, and prices are being lowered. So we're starting to see a little bit more of a buyer's market, which definitely helps.
I think during that really crazy seller's market, our loan originators became somewhat therapists too, kind of really helping our members in that. Um, that was hard.
We did. I can vouch for that.
Right, right. I know.
Uh, some of the other things when you're making an offer that you want to think about is contingencies on the offer. There's a handful that are kind of standard that you can just about always have. A home inspection contingency, an appraisal contingency, and then if you are getting a mortgage, you're always going to want a financing contingency in there. So all of these essentially allow you to some flexibility in the fact that if the home inspection doesn't go well, or if once the lender orders the appraisal, maybe the appraisal comes in low, you can either try and back out of the contract and still get your deposit back that you've paid, or you can try and renegotiate the contract if something needs to be fixed, or if it came in low. And then the financing contingency is kind of your parachute, so to speak, if you're financing. So, hopefully the financing would never fall through later in the game, closer to closing. But unfortunately, it does happen from time to time. One of the most common causes of it is that maybe somebody unexpectedly loses income, you know, 10 or 12 days before closing. And then all of a sudden the lender just can't approve and close on the loan. If you have that financing contingency and you're still within it, you can at least, again, get your deposit money back and back out of the contract from the home. In that situation, without a financing contingency, you now maybe lost some income. You can't buy the home, and you may be out of the money that you put down as a deposit, because the seller could keep that if you don't have that contingency built in. So having some contingencies built in there for that kind of stuff is important to kind of protect yourself and through the process.
Yeah, and contingencies are really in there. I mean, they're twofold. Like, depending on the type of contingency, would you not agree that, some are more to protect the seller and some are more to protect the buyer? I mean, in a contract, that's kind of what both parties are looking for. But really here we're talking a lot about like what's going to protect the buyer. Would you
Yeah.
agree, Nick?
Yeah, absolutely. Yeah, these are the ones that as the buyer you'd always want to have, just again to give you some protection and some flexibility if that initial viewing of the home all of a sudden starts to uncover some things when the inspection is done
Yeah.
and the appraisal is done, and maybe things need to be renegotiated. And then really, it kind of takes us to the negotiations of the offer. As I said earlier, in a seller's market, there may not be a lot of negotiations that go on, or back and forth. In the buyer's market, it may be a little bit more. But one thing to remember is when you're making an offer, you're essentially signing a contract that you're offering to buy the house for, X amount of dollars, and you put all your contingencies in that contract. And if the seller accepts it, then they essentially sign it, and then you're under contract to buy that home. So just making sure that you understand that when you go into it, and that you can't, if you make an offer, it's not just one of those, oh, they accepted, but never mind, I want to change the terms, and it's not quite that easy when it comes to buying a home. You're actually offering, through a contract. So, but again, it's not always going to be accepted right away. It might be that the seller comes back and counter offers, and if you offered less than their asking price, and maybe they meet in the middle, or maybe they, reject one of the contingencies, or there's times where Again, in a seller's market, they may have 3 or 4 offers, so you may just get a flat out rejection. We're sorry, we're going with a different offer. But that's, just important to remember that once you make an offer, that's kind of the start of the negotiations, and you are signing a contract. So, once you can't really usually go backwards from that first offer that you make.
Once your offer is accepted, your clock really starts pretty quickly on that. So you're going to have in your contract, there's going to be an inspection period, usually 10 to 15 days. So it's a pretty tight window that you have for that, where you're going to order your home inspection. What that's going to do is an inspector is going to come in. It's going to be a third party person that's going to come in, and they're going to go through that home with a fine-tooth comb. They are going to look at things, the major things such as the roof, the AC, the electrical, those types of things. And they're also going to look at some of the minor things. They're going to look at, do the kitchen drawers close? Do all of the outlets work? The light switches? I mean, they're really going to look at everything. And then they're going to provide you with a pretty extensive report on that. And then it's you as the buyer, it's up to you to kind of go through that report and decide, are any of these things that are maybe deal breakers, or are they things that I want to go back to the seller and say, hey, they're saying that the roof is going to need replaced really immediately, so now we need to readjust this price because that wasn't something that I was aware of. So it gives you the option to go back and renegotiate or back out altogether if there's something in there that is just going to be a complete deal breaker for you. But it also just gives you that extensive list that you can look at. They may find that a light switch doesn't work in the kitchen, and you may look at that and say, that's a pretty simple fix for me to do. I still want to proceed and get this home. This is still my dream home. But that inspection period, that window, once it opens, is for you to get the inspection and handle any of your renegotiations that you need to do. So you want to act on that pretty quickly once your offer is accepted and really get the ball rolling on that.
Yeah, and so we had someone I know this is probably a quick answer, so I'm just going to mention it here, but someone asked if you can have a home inspected before an offer. Now, I know an official inspection report does cost money. So what would you say to a borrower that says, well, I want to get it inspected before I make an offer? What's your advice?
Well, either way, you as the buyer are the one who's really going to be paying for that. There may be some sellers that may agree to that, but a lot of them, a lot of times, you're up against a clock also to get your offer in. There are times, I've seen it sometimes where it's a house that's been on the market for a while, and, they go ahead and go through the inspection period before finalizing the contract. But it is much more common to wait. The seller is really going to want to have kind of that contract where you're saying, I'm going to buy this house if the inspection is good. So really, from a seller's perspective, they're probably going to say that they want to be under contract, because otherwise you're having someone come through their home and you don't have any intentions to really buy it possibly. So, I mean, you would still have intentions because you're spending money on the inspection, but they don't have that same, comfort of this is under contract. Once they go through here, they know that they're wanting to buy it.
And that's where the home inspection contingency really comes into play. Yes. And is pretty standard on just about every contract of 15 to 20 days usually. In fact, if you were looking at a home that a seller refused any home inspection period contingency, it would kind of be a red flag that there might be something major wrong with the house, because a seller is usually okay with that, because really there's times where the inspector will uncover something that the seller doesn't even know about. There might be a window in a bathroom that is slightly leaking that the homeowner never goes into. So they didn't even know it was leaking. So yeah, usually it's usually done after contract, but kind of within that contingency period. So again, if the inspection comes back really bad, you could just walk away and back out of the contract.
Yeah. And really, it's important to note too that the inspector is really working for the buyer. The seller owns the home. The seller is living in the home. The seller wants to sell the home. So, it's the buyer that actually selects the inspector, and then, they're going to come back with a complete report, and they're providing that report to the buyer. Do they give it to the seller also?
They only give it to the buyer. And also another thing to kind of mention is you can be there with the home inspector when they're going through the home. It's something we kind of actually recommend if you can take that time and be there with them, because they'll be able to point some of the stuff out. When you get this lengthy report, you may say, I don't know what that's talking about. But if you're there with them, then they can kind of point it out to you. And then when you get the report, maybe it's not as daunting when you're looking at it, or they may be able to explain, like, I'm going to list this in the report, but this is a pretty minor thing. So I also always recommend to my buyers, try and be there if you can, because you can have that conversation. You're paying for that inspector and their time. So being there with them and asking them the questions is something you can do as well.
And one thing I always told people too is a home inspector is going to find something wrong with the home. All right, so you've made an offer, you're under contract, you've ordered your home inspection, and kind of at the same time as the home inspection going on, usually is when you're going to meet back with your loan officer, or at least speak to him over the phone and kind of finalize the application. So as Katie said, pre-approval is when they're going to pull credit and can kind of give you, an idea of what the interest rate and stuff is going to be at that time. But as far as interest rates, you can't officially lock an interest rate in until you're under contract on a home. So this is really the time that as soon as you're under contract, usually you're going to want to reach out and lock in the loan that you want to do. You can also kind of go over terms again. What's the difference of the payment of a 15, 20, 30 year? Do you want a fixed rate mortgage, which is still the most common in the market, or do you want an adjustable rate mortgage, or an ARM? We do see people taking more of those right now with the rate market being a little bit higher. But it's still a little bit of a gamble, if you will, because on an adjustable rate, you essentially have a fixed period for maybe 5 or 7 years, but then after that, that rate could start adjusting on you. And so if the home is really going to be a long-term home and a long-term investment, most people are still taking the fixed rate mortgage and kind of finalizing everything at that. And then as you finalize the mortgage too, the lender is who would actually order the home appraisal for you. So the home appraisal is different than the home inspection that we just discussed. So the home inspection you order, or if you have a realtor, the realtor would order, and then you would pay for that up front and kind of meet the inspector out there to go through everything. An appraisal is really a licensed appraiser that's going to go out to the home. They may note anything major wrong, like if there was a tarp over the roof, they would say, hey, the roof appears to have a leak. But they're not going to, or if there was a window broken or a door that wasn't closing right, but they're not going to check the outlets and go crawl through the attic and get on top of the roof and that sort of thing. They're really just going to take the home that you're buying. They're going to try and find comparable homes within a certain radius that have already sold, and then give a report that says, hey, based on other homes in the area that have sold, my professional opinion is that this home is worth X amount of dollars. And that's where the appraisal and that appraisal contingency we talked about earlier protects you from overpaying for a home. So let's say you were under contract for 250,000 and the appraisal comes in at 240. At that point, you kind of have some options. You can either back out of the contract altogether and just say, I don't want the home. A lot of times the buyer may then try to renegotiate with the seller and say, hey, look, here's the appraisal report. An appraiser says it's only worth 240. Can we come down off of that price? Or there are times where if it's a seller's market, the seller may not be willing to budge, and if it's still a home that you really want to buy, you can still proceed, just with the knowledge that you're going to have to pay a little bit more out of pocket for that home because that appraisal came in low. So we like to make that clear between the two, that the lender will order your home appraisal, and it's really just the value of the home, and that home inspection is something that you do to really check out the quality of the home and if there's any deferred maintenance or anything like that that may cost you money down the road.
think it's really common to just, for some borrowers to mistake one for the other.
Yep.
Yeah.
Yeah, absolutely.
All right, so once you've had your inspection, you've chosen your loan product, you kind of have the ball rolling on that side of things. The next thing that's something that you'll want to work on is shopping for homeowners insurance. So you're going to want to I always recommend getting a few quotes, speaking with a few different insurance companies and seeing what they have to offer. Insurance is going to be required if you're getting a loan on the home. We obviously would recommend it even if you're not getting the loan. It's there to ensure your property, your personal property inside the home, if the home floods, if you have a fire, those types of things. So it can be really important for you to have that insurance. And then there's some things that kind of can affect the rate. So as you're getting those quotes, the insurance agent is going to go over, a lot of things with you. They're going to get kind of an application of their own, if you will, on you and the home both. So as you can see here on the screen, there's some different things that are going to affect the rate and kind of the quote that you get from the insurance company. Just some to kind of think about are the age of the home, how, the value of the home is going to change things. If there were to be a complete loss from a fire, what is the insurance company going to be obligated to pay on that? So that kind of can affect what the cost is for your insurance. And then there's some other kind of non-common things that you'll also see. My first home, we had a fire hydrant outside of our fence, technically on our property. So we had very low insurance because if there were to be a fire, they didn't have to go far to get water. So it always surprised other insurance companies when we would shop around, that our quote was so low when they would pull it. And it always ended up being because we were in close proximity to the fire station. And if they needed to hook up a hose and put out a fire, they didn't have to go far. They didn't have to go around a corner and run a bunch of hose and that type of stuff. So just some kind of uncommon things that can come up as well on the insurance. But you'll kind of get those quotes, and then once you choose who you want to proceed with, you'll provide it to the lender and they'll get it taken care of with the loan.
All of those things are such good such good things to think about too when you're buying a home. I mean, like the proximity to emergency services, like if you have kids, like that might be really important to you, not just for insurance, but just as a homeowner. So
Yep, absolutely. Yeah. I mean, you never know when you may just need to
I know,
run them up to you always hope that's not going to happen, but you want to make sure you're prepared for it.
yeah.
All right, so nearing the end of it, gotten your insurance, all the inspections and contingency they're over with. So really kind of getting ready to close on the home. So usually I always tell people a few days before closing, there's usually going to be like a final walkthrough and inspection of some sort. We've even seen it sometimes just the morning of closing, a few hours before. But this is usually done just with you. If you have a realtor, maybe just you and the realtor go. And this is kind of just to make sure, obviously, like I said, if you were buying an existing home that someone was living in, they have since moved out, and making sure that they didn't accidentally break a window on their way out that they didn't tell you about, or that, a pipe didn't burst after they moved out and flood something. Or in the case of maybe a brand new home that a builder just built, maybe at the initial contract time, there was still some paint that needed to be touched up or a door that needed to be hung. So that final walkthrough is, again, just kind of making sure those items were done and completed before you go sign all the paperwork. And then usually a few days before closing is when you're going to really make sure to bind that insurance policy, let the insurance company know which insurance company you're going with them, so they can get your policy in place. And then usually a couple days before is when you're going to get that exact figure for what your total cash you need to bring to the closing. So between your down payment and your closing costs, that's going to be estimated to you in the beginning, and throughout it can be estimated, and it's going to be pretty close to what that final figure is. But there's different prorations that are done, usually by the title company. for things like the property taxes. If there is a homeowners association, depending on when those dues are done, sometimes they have to be prorated from the seller to the buyer or vice versa. So the title company does all those kind of prorations all the way up to the day of closing, and then you'll get an exact figure to the penny as to what you need to bring to the closing. And it's usually pretty close to those estimates, but the estimates are always going to kind of be round number estimates and not exact to the penny with all those prorations figured in. And then usually, depending on the home and the utility company and stuff, there are some services you can set up pre-closing. For example, utilities is one that you can usually get transferred straight from the prior owner to your name and not have to have it shut off. There's others like internet and TV that sometimes you have to wait till you've closed and get those set up. But sometimes getting that set up with the utility company, that way you don't have to actually shut off the water or the power or anything. They can just transfer it.
Ah, finally, the
Yeah.
final step.
So once you've done all that, and you're showing up to the closing, um, we always jokingly tell people that have never gone through it to just make sure that your hand is ready and you have a pen that's full of ink, because the closing packages these days on a mortgage are usually over 100 pages, with probably close to 70 or 75 signatures from you that it would need. So, every time a new regulation or rule or something is put in place in the mortgage world, which seems to be almost yearly these days, it usually adds a new disclosure, a new document. And a lot of them are documents that you may have already seen before earlier in the process, things like the Patriot Act and Fair Credit Reporting Act, and just some very generic disclosures. But this is also where you would see the actual mortgage document that gets recorded in the public record. You'd see a copy of the deed. You'd see a copy of your actual note. This is where you'd go through all of those documents and you're going to have to sign everything. So, it's one of those things that if you've never done it before, sometimes you show up and see that stack of paper and it can be intimidating. But the closing company usually kind of goes through and can explain each document to you also. That way, if you're one that wants to read every word, you can. But some of them are pretty generic disclosures that are given to every single buyer, so they can kind of explain what it means and you can go through and sign them.
Yeah, I can imagine that takes a really long time. 100 pages.
They usually block an hour off for
Yeah.
a mortgage closing, and that really, like I said, depends on how much of the words you want to read. We've had people that take that full hour and then some, and then others, if you've seen all the documents before, it's maybe 30 minutes and you're just signing and moving on, ready to get your keys and go start moving stuff into your new house.
I'd be ready to just go. But it's good to understand what everything is that you're signing. And I believe most of the time, if not all the time, you do get a copy of everything that you sign. So if you don't, I'm sure they would make a copy upon request.
Yeah, the title company will always make a copy. These days, a lot of title companies will ask. Sometimes they can deliver it to you electronically, via email or even a thumb drive. Or if you still want, 100 paper copies, they'll make it. But a lot of them have moved to, because the packages have become so big, being able to scan and give them all to you electronically, so you can just store your closing package that way after you've signed.
Smart, very smart.
And another thing with that closing too is, I mean, really the title company or real estate attorney that you're closing with, they're really kind of a third party, like in between. So they're going to go over the parts, that are really important for you to pay attention to, making sure that your name is spelled correctly on the mortgage and, those type of documents. They're not, necessarily like working for the seller versus the buyer type of thing. So they're going to make sure you know what you need to know in there as well. And, they'll let you read as much as you want, like Nick said, but if they tell you one's pretty standard and you can kind of just scan over it, you usually can get out within that hour and get moving into your new home.
So much good information. Nick and Katie, thank you so much.
Awesome. Thanks, everyone.
All right, thank you.